When people talk about the gold rush, they almost always picture the prospector.
Right, yeah. The guy standing knee-deep in a freezing river.
Exactly. Panning for that one, life-changing nugget.
Yeah.
It's this incredibly romanticized vision of risk and reward.
Oh, absolutely. But if you actually look at the history, those aren't the people who got rich.
No, they weren't. The people who consistently walked away wealthy were the ones selling the pickaxes and the shovels and the tents.
Yeah, the tool merchants.
Right. Because they didn't care if you struck it rich or if you went completely broke, as long as you bought their tools to keep digging.
It's basically the ultimate infrastructural play. The prospectors take on all the existential risk while the tool merchants just quietly power the entire ecosystem.
Exactly. And that exact dynamic is playing out right now, today. But the rivers are, well, artificial intelligence and commercial space networks.
That's a great way to frame it.
Right. And the prospectors are these massive tech giants pouring just billions into data centers and satellite constellations.
And the pickaxes in this scenario.
The pickaxes are microscopic, highly specialized chips and lasers, which brings us to the core of our deep dive today.
Yes.
We are looking at a Swedish company called Sivers Semiconductors.
Which is a fascinating case study.
It really is. And we're leaning on a few key sources for this. We've got their hyper-detailed 2025 annual report,
Yeah.
An update from the MSCI Global Small Cap Indexes from May of 2026, and a really intense Reddit thread.
Oh, yeah, from the retail investing community.
Right, tracking institutional ownership of their stock. And we're using all of this to basically explore a massive disconnect.
Because when you lay these documents side by side, it's almost jarring. You have this company holding the vital physical keys to the AI and space tech revolutions, but its financial and market reality is just completely turbulent.
Yeah, I want you to imagine, as an investor, looking at an entity that is simultaneously building the literal backbone of the future.
While fighting off internal accounting fires.
Exactly. And algorithmic sell-offs. It's wild. But, to understand why the market is pulling Sivers in two completely different directions, we have to start with the actual hardware they're building.
Right, because this is definitely not consumer software. You are never going to just buy a Sivers product off a shelf.
No, definitely not. They're entirely business to business.
Operating at the absolute bleeding edge of physics, really. Just to give you a sense of their DNA, they have about 130 employees.
Spread across, Sweden, the U.S., Scotland, and India.
Yeah, exactly. And out of those 130 people, 30 hold PhDs.
Wow. That is just a staggering ratio of pure academic brain power for a corporate payroll.
It's honestly necessary, though, because the problems they are solving, they exist at a microscopic scale. Sivers splits its business into two main divisions.
Wireless and photonics, right?
Yep, both dedicated to what the industry calls intelligent connectivity. So let's look at the wireless division first.
Which, according to the 2025 report, grew by an explosive 53% year over year.
Huge growth. And the specific technology driving that is something called millimeter wave beamforming chips.
Okay, I have to stop you right there.
Sure.
Because beamforming sounds like something straight out of a science fiction novel. How exactly does a microchip form a beam?
It's a great question. So to understand beamforming, think about how traditional Wi-Fi or radio towers work. They basically act like a floodlight.
Just blasting a signal out everywhere.
Exactly. They blast the signal outward in every possible direction, just hoping your device catches some of it.
Which sounds pretty inefficient.
It is. It wastes a tremendous amount of energy, and the signal degrades really quickly. Beamforming, on the other hand, acts like a highly targeted laser pointer.
Oh, I see. So instead of shouting into a crowded room, it's more like cupping your hands and whispering directly into one person's ear.
Precisely. So these chips use phased arrays, which are basically multiple tiny antennas working together, and they manipulate the radio waves so they converge into a single, focused, high-speed beam. And they can electronically steer that beam in milliseconds to track a moving target.
Which completely explains why their lead customer, Allspace, just hit what the defense industry calls technology readiness level 6.
Right, using Sivers chips with the U.S. Army.
Yeah. Hitting TRL 6 is a massive threshold, right?
It's huge. It means the technology has officially graduated from a sterile laboratory.
And has been demonstrated in the real world.
Exactly, in a relevant real-world environment. Imagine a military vehicle moving across uneven terrain. It needs constant high-bandwidth satellite communication.
And a traditional dish has to physically rotate to track a satellite.
Right, which is slow and mechanical. Sivers beamforming chips do it entirely electronically. They instantly steer the signal to keep the vehicle connected to a satellite moving at, thousands of miles an hour in low Earth orbit.
That is incredible.
Yeah.
And defense is really just one piece of this pie.
Oh, absolutely.
The report details a $1.5 million deal with South Korea's Doosan to develop Ka-band satellite panels. Now, I know Ka-band refers to a specific, very high-frequency range of radio waves.
Yes, it does.
Well, why is everyone fighting over that specific frequency right now?
Because we are literally running out of invisible real estate.
Spectrum congestion.
Exactly. The lower frequencies are completely jammed with television, traditional cellular networks, radio. The Ka-band sits way higher up the spectrum.
So it's basically an empty highway.
Right, and the advantage is that it can carry vastly more data at much higher speeds.
Okay, but there's always a catch.
There is. The disadvantage is that it is highly susceptible to interference. I mean, even heavy rain can disrupt a Ka-band signal.
Oh, wow. So that's why you need the Sivers chips.
Exactly. You need incredibly sophisticated hardware to blast a signal through those disruptions without losing the data.
So they are laying down the invisible high-capacity tracks that allow modern satellite internet and 5G networks to even function.
Yeah, they really are.
I mean, they even landed a $900,000 contract with the European Space Agency. Plus, like a $2.8 million order from Taxion Networks for 5G fixed wireless access.
So it makes total sense why the wireless division jumped 53%.
It totally does. But, if space and defense are hungry for data, the artificial intelligence sector is absolutely starving for it.
Starving is the right word.
And that bridges us right to their second division, which is Photonics. That one grew 17% in 2025.
And this is where the physical limitations of our current infrastructure become just glaringly obvious. Sivers Photonics manufactures something called DFB lasers.
That stands for distributed feedback, right?
Right. And these lasers are specifically designed for AI data centers.
Okay, I have to push back here.
Go for it.
When I picture an AI data center, I picture endless rows of server racks, right?
Yeah.
Just humming away, calculating algorithms. Why on earth does a server rack need a laser?
It comes down to the sheer volume of data AI requires. When you are training a massive language model, you aren't just using one computer.
No, you're using thousands of them.
Exactly. You're networking thousands of graphics processing units or GPUs together, and they have to share petabytes of data instantaneously.
Oh.
Historically, we connected all these servers using copper wiring. Electricity flows through the copper to carry the data, but copper has hit a physical brick wall.
What kind of brick wall? Like it literally just can't carry any more information.
Exactly that. When you try to push that much electrical data through copper at these insane speeds, a few things happen.
Okay.
First, the signal degrades over very short distances. Second, it consumes a massive amount of power just to literally push the signal through.
Because of the resistance.
Right. And third, all that electrical resistance generates an incredible amount of heat.
So the data center is essentially choking on its own electrical friction.
Yes.
To use like a mechanical analogy, it feels like the AI industry is trying to push millions of giant courier trucks down a physical copper highway, and it's just resulting in a massive overheating traffic jam.
That is the perfect way to visualize it. So the entire architecture of the data center is pivoting. Instead of the highway of trucks, they are switching to pneumatic tubes that use light.
Oh, wow.
Yeah. They are replacing electrical signals over copper with optical signals over fiber. They use lasers to convert the data into light, shoot it across the data center with zero electrical resistance, and then convert it back.
And Civils is manufacturing the external laser sources that make that transition possible.
Exactly.
And the speeds they are targeting are completely mind-bending. The report notes they're partnering with major players like ONET Technologies, WIN Semiconductors, and POET Technologies.
Right, to help the industry jump from 800 gigabit bandwidths to 1.6 terabit.
And even 3.2 terabit architectures. That is an oceanic amount of data moving at the literal speed of light.
It is the defining bottleneck of the AI boom right now. If you cannot solve the optical interconnect problem, you simply cannot scale your AI models. It is that simple. And Sivers is positioning itself as the foundational manufacturer for those critical laser arrays. Plus, they're prepping for a late 2026 production ramp-up for a major LiDAR customer in the autonomous vehicle space.
So you take the beamforming chips for space networks, you combine it with the DFB lasers for AI data centers,
Yep.
and you get the headline number from their 2025 annual report. Record net sales of 306.5 million Swedish krona, a 40% overall jump.
Which looks phenomenal on a percentage basis.
Right. But we really have to put that Swedish krona number into perspective for a global audience.
Good point.
Because 306.5 million krona is roughly 28 to 30 million US dollars. When I did that math, I actually had to double check my work.
It's a surprisingly small number, isn't it?
It really is. Sivers is powering the US Army, the European Space Agency, and next-gen AI networks, but they are generating the annual revenue of like a busy regional car dealership.
Yeah. It is a stark reminder that this is still very much a microcap company.
It is.
And that scale is vital to keep in mind. Because when you have world-changing tech housed within a company that small, Wall Street behaves in very peculiar ways.
Which brings us perfectly to our next source.
The Reddit thread.
Yes. Because if you're a retail investor reading about this tech, you are probably scrambling to buy shares. And if you ventured over to the SIVE stock Reddit community recently, you'd think the major institutions were doing exactly the same thing.
Right, there's a lot of excitement over there.
There was. A user named DifficultGoal9160 posted a Swedish regulatory notice showing that JP Morgan Chase,
One of the largest financial institutions on Earth.
exactly, showing they now own a 5.2% stake in Sivers.
And for the average retail investor, seeing a mega bank take a 5% stake triggers an immediate reaction. They think, the smart money has arrived.
Yeah, it's viewed as this overwhelming vote of confidence in the underlying technology. But I love when crowdsourced research actually digs into the fine print.
It's the best.
Another user in that thread, HungDaddy61, throws completely logical cold water on the whole celebration. They pull the actual filing and realize that the 5.2% stake is heavily split.
Right, it's not all pure stock.
No. Only 3.28% is in direct shares. The remaining 1.98% is held in, quote, financial instruments.
And that distinction completely changes the narrative of why JP Morgan is actually buying this stock.
Okay, so explain that mechanism to me. Why does it matter if it's direct shares versus financial instruments? I mean, isn't 5% just 5%?
Not at all.
Okay.
If an institution buys direct shares because they believe the company's value will rise, that is called conviction buying.
Right. They like the stock.
Exactly. But megabanks operate a massive side of their business, creating and selling complex financial derivatives to their clients.
Like swaps or options.
Yeah, swaps, options, structured products. Let's say a massive hedge fund client comes to JP Morgan and says, hey, we want to make a highly leveraged bet on European semiconductor growth. And JP Morgan sells them a custom derivative product that tracks companies like Sivers.
Okay, so the client is basically placing a bet with the bank.
Exactly. But JP Morgan doesn't want to actually hold the risk of that bet.
They don't want to gamble.
Right. They are in the business of collecting fees, not gambling on microcap tech stocks. So to balance their own books and remain neutral, the bank has to go out into the open market and buy the underlying securities.
Ah. Okay, so the Reddit user was pointing out the hedging theory.
Bingo.
JP Morgan isn't necessarily buying Sivers stock because their analysts think the beamforming chips are incredible. They're buying the stock to act as a mathematical counterweight to a bet they sold to someone else.
Right. It is pure risk mitigation. That 1.98% held in financial instruments strongly implies that JP Morgan is engaging in delta-neutral trading strategies.
They're just balancing an equation.
Exactly. It's not a parade for Sivers technology. It is literally just Wall Street plumbing at work.
But, that raises a massive question for me.
What's that?
If Sivers technology is as groundbreaking as we just discussed, why wouldn't JP Morgan just buy the stock out of pure conviction? Why the need to hedge so carefully around a company that just grew its revenue by 40%?
Because hardware is an absolutely brutal business.
Is it the financials?
It's the financials. When you flip past the glowing technology summaries and get into the financial accounting in the back half of that 2025 annual report, you see profound structural cracks.
Yeah, I saw those numbers.
Yes, they had record sales of 306.5 million krona, but their operating profit was negative 177.8 million.
Wow.
And their total profit after tax, negative 2.6 million krona.
I mean, how does a company grow its top-line revenue by 40% and still lose over 200 million in a single year?
It is the tragic physics of scaling hardware. Software companies can, copy and paste code with near zero marginal cost.
Right.
Sivers has to maintain physical clean rooms, source exotic semiconductor materials, run intense quality assurance, and, oh yeah, employ 30 PhDs.
That can't be cheap.
It's not. The research and development costs alone required to jump from 800 gigabit lasers to 3.2 terabit lasers are astronomical. They are spending money at a futuristic pace, but collecting revenue at a present-day reality.
It's almost like they are trying to fly a supersonic jet, but their instrument panel is completely broken.
That's a great analogy.
And I'm not just using that as a loose metaphor either.
Right.
The 2025 report reveals that Sivers was exploring a dual listing on the NASDAQ in New York.
Right.
And to prep for that, they had to audit their books. And they found such severe errors that they had to restate both their 2024 and 2025 financial reports.
And a revenue restatement is, well, it's one of the most frightening things an institutional investor can hear.
I bet. They actually had to shift recognized revenue out of 2025 and push it into 2026 and beyond. They bluntly admitted in their own report to having material weaknesses in their internal control over financial reporting.
Yeah, that phrasing is a huge red flag.
They had to scramble to implement new IT systems and hire external advisors just to get their math right. So why is recognizing revenue so difficult for them?
Because in complex hardware contracts, especially with defense and space agencies, revenue recognition isn't as simple as swiping a credit card.
You can't just count the money when you ship the box.
Exactly. You might ship the physical chips, but the contract stipulates that you don't actually earn the revenue until the client successfully integrates those chips into their proprietary software months later.
Oh, I see.
So if Sivers' accounting department books that cash when the box leaves the warehouse, rather than when the milestone is actually met, they are out of compliance.
And when you are already a microcap company burning cash, an accounting error like that destroys trust.
It really does.
But the vulnerabilities don't stop at the accounting desk. If you look at their revenue base, the report openly states that over 50% of their 2025 revenue came from just 3 customers.
3 customers. That is an existential level of concentration risk.
Right, because if you have 1,000 customers and you lose one, you barely even notice.
True.
But if you only have 3 major pillars holding up half your business, and one of them gets a budget cut or, I don't know, pivots to a different technology,
Your entire company could collapse overnight.
Exactly.
Especially when you're dealing with government defense contractors where projects can be delayed for years purely due to political red tape.
Right.
You are entirely at the mercy of their timelines, but you still have to pay your engineers every 2 weeks.
And just to add insult to injury, the report notes they suffered a cyber attack in 2025.
Right, I saw that.
They managed to contain it, but it still forced them to eat 8.5 million krona in non-recurring recovery costs. When your profit margins are already deep in the red, an unexpected 8.5 million hit is just a brutal gut punch.
It perfectly illustrates the dichotomy we discussed earlier. You have these elite engineers successfully hitting TRL-6 with the U.S. Army.
Making breakthroughs.
Yeah, while down the hall, the corporate IT department is fighting off hackers, and the accounting department is restating historical revenue.
It's 2 different worlds.
Yeah.
Which brings us to the final piece of the puzzle and the brutal reality of how modern markets punish those corporate missteps.
The MSCI Global Small Cap Indexes update.
Yes. From May 2026.
This is where the mechanics of modern finance really intersect with Sivers' struggles. On May 12, the MSCI announced that Sivers Semiconductors, along with 3 other Swedish companies, would be deleted from the MSCI Sweden Index.
Effective May 29.
Exactly.
Now, if you're sitting there holding shares of a company that just got dropped from a major index, your first question is probably, how bad is this, practically speaking?
Mechanically, it is devastating in the short term.
Because of passive investing.
Exactly. The modern stock market is heavily dominated by passive investing. There are trillions of dollars sitting in index funds.
Like retirement accounts, pension funds, 401ks.
Right. And those funds do absolutely zero independent research. They don't know what a millimeter wave beamforming chip is.
They probably don't even know what a Sivers is.
Nope. And they don't care about the physics of DFB lasers.
They just blindly track the list provided by MSCI.
Exactly. So if the MSCI algorithm calculates that Sivers' market capitalization or their liquidity has dropped below the required threshold, they get deleted.
Just automatically.
Automatically. And the moment that deletion becomes official, Every single index fund that tracks the MSCI is mathematically forced to execute sell orders on Sivers stock.
Wow. So it has absolutely nothing to do with whether the technology actually works.
Nothing at all.
The U.S. Army could be thrilled with the chips. AI data centers could be relying on the lasers to prevent overheating. But a massive wave of automated selling hits the stock anyway, purely because a spreadsheet updated.
It is the cold, unfeeling reality of algorithmic capital. A brilliant technological achievement offers zero protection against the mechanical rules of an index fund rebalancing.
Let's pull all this together because the picture it paints is just deeply fascinating.
It really is.
We started by looking for the modern merchants selling the pickaxes for the AI and space gold rush. And we found one.
Sivers Semiconductors.
Right. They have 30 PhDs designing the invisible high-capacity tracks for the future of human connectivity. They are literally bending light and radio waves to solve the biggest bottlenecks in modern infrastructure.
Yet simultaneously, they are entangled in the messy human realities of corporate survival.
Yeah.
They are battling severe operating losses, material weaknesses in their accounting, terrifying customer concentration, and the ruthless algorithms of Wall Street index funds.
It is absolute proof that having the best technology in the world does not automatically grant you a stable business.
No, it doesn't.
The physics of photons and millimeter waves are predictable, they're reliable. The mechanics of human governance, cash flow, and passive capital are just chaotic.
It requires an entirely different set of skills to navigate, and succeeding at one does not guarantee success at the other.
Which leaves you with a really unsettling thought to chew on long after we wrap up today. We have built a global financial system that is increasingly dominated by passive, algorithmic index funds. These funds demand perfect corporate metrics, predictable cash flows, and massive scale.
Right.
But the companies building the physical hardware foundations of our future, the ones figuring out how to move terabits of data with lasers so our AI doesn't melt down, they are inherently messy, they're capital intensive, and they're volatile.
They have to be. Innovation is messy.
Exactly.
Yeah.
So if the algorithms systematically punish and starve these microcap innovators for their financial growing pains, who is going to be left to fund the physical infrastructure of the future?
That's a great question.
We might be building a financial system that is incredibly efficient at trading stocks, but structurally incapable of supporting the messy physics of actual innovation.
Something to really think about.
Thanks for taking the plunge with us today. We'll see you on the next deep dive.